Hi, it's Adrian here, and today I'm going to talk to you about setting trading objectives when you have your second or third trading system and beyond. In other areas of the website, we already talk about setting your trading objectives for the first system, which are things like your return over your risk, how many trades you want to do per day, per week, per month, and so on, what percentage of your trades you want to have as winners or losers, and various other things like that, including also your maximum drawdown. Now, all of those things still hold when you're designing your second system or your third system, but there's a couple of extra considerations when you've got one system already and you add another one and another one into your overall portfolio of trading systems, and that's what I want to cover today. So what I've got here is the equity curve of your first system, system 1. And what you might notice is when you look at your equity curve for your first trading system, there might be some things that you're unhappy with, so some areas of performance. So if I look at this one, for instance, between here and here, we've got a bit of a drawdown. And obviously drawdown is undesirable. Now you can never eliminate all of your drawdown, but it is an area of focus when you're adding in another system to try and reduce the drawdown of the portfolio as a whole. The next thing to notice is that there's this flat spot here. And usually the thing that causes a flat spot in your equity curve is a set of market conditions that your first system just doesn't trade during. So this might be, say, a trend following system that only takes a position in a bull market. Now, if this is a bear market right here, then you won't take any trades, and so you'll have this flat spot in your equity curve. And then maybe you've got another drawdown that happens over here that's a little bit too big for your comfort, and what you want to do is design a second system to try and reduce the impact of that drawdown. So now that we've seen in our first system the areas that we want to improve, I want to talk about how do we go about setting our objectives for correctly fixing or addressing those problems in our equity curve or in our backtest by adding in our second system or a third system. Now, the immediate temptation for most traders is to jump in there and test a bunch of different variations of system 1 or add in various other system ideas that they've played with until they find something that just by happenstance has eliminated those drawdowns or that flat spot. Now, this is a big mistake, and it's a mistake because it's a form of curve fitting. Because what you haven't done is step back yet and look at what are the underlying causes of these areas or periods of underperformance. So if instead of jumping straight in there and trying different system ideas and playing with parameters, we first have a look at this and say, well, what was happening in the market at that point in time? And once we know what was happening in the market at that point in time, we also know this is a period of drawdown in our first system. So what we need is a system or set of parameters or rules that profit when that set of conditions comes up. Now, it's not so much about eliminating this drawdown in that particular backtest. What it's really about is finding the set of conditions that was going on in the marketplace at that point in time and designing an approach which will address those conditions. It's very easy through curve fitting to make it look like this drawdown disappears just by changing the parameters, tweaking it, adding extra filters, but that's not going to help you in real-time performance. What we've instead got to do again is take a big step back, form a hypothesis about what were the market conditions at this point, and then therefore design a new system or new set of rules that makes money during those conditions. So similarly for this area here, the flat spot, we have to take a step back and look at the market conditions that were happening at that point in time. And chances are it's for one of a couple of reasons. Either say this is a long side trend following system. Either it was a bear market, so the market was trending down, in which case obviously you're not going to get any signals, so your equity curve is going to look flat. Or maybe it was trending up, but the market was too volatile. And if the market is too volatile, and maybe then your system is keeping you out of that, or because the trends aren't strong enough or aren't smooth enough. And this has happened to me in the past as well. So having a look at those conditions and saying, oh, okay, right, well, bear market, therefore I want a system that will generate some trades and trade profitably in those conditions. Or if it's because volatility had spiked, maybe I need a system which trades or benefits from an increase in volatility, and therefore that will take some trades there. And then say we look at this other period of drawdown, and what we need to do is understand whether or not that drawdown is caused by similar market conditions to this drawdown. Now, it could be that this was a full-on bear market and this was just an intermediate correction, or it could be the other way around. Now, you can often experience a drawdown partway through a bull market where there's a correction and the market sort of basically comes off 10-20%. You'll find you'll get a dip in your equity curve when that happens. What can also happen at the end of the bull market, when the whole market turns around, if you're trading alongside stocks this is, all of your positions take some time to get down to hit your trailing stop, and then you get out if you're trading a trend following system. Now this period of time when the stocks are coming down before they hit their trailing stop, that is a drawdown. And that could be what this is here. So if that's what is causing you a drawdown and you're uncomfortable with that, your second system then might need to be some sort of mean reversion system or something which profits from when your other trades are coming off. Now that's a very different approach than just looking at the raw equity curve and saying, right, well, I'm going to play with another system and just test different parameter sets until I find something that makes this look a bit smoother. So I guess just like setting your objectives at the very beginning, what I'm encouraging you to do here, once you've got system 1 up and running and you're looking at system 2, take a big step back and go, what am I trying to achieve with this? What are the market conditions under which I'm looking for profit? So then go and intentionally design a set of rules that will give you that. And by doing that, you get a system 1, system 2 combination, which is far more robust going forwards.